rather quickly, and here's why.
It has moved up.
Its global economy may not be able to take too much more.
Are we undergoing a recession despite the fact that bonds have sold off? The stock market is struggling. Inflation is through the roof, and cryptocurrencies are collapsing. The majority of economists contend that for the time being, at least, a true recession has not yet occurred despite the widespread predictions of impending economic doom. Cathie Wood from ARK Invest is unconvinced. Why does Cathie Wood think so? Before asserting that the U.S. economy is probably already in a recession, ARK Invest CEO Cathie Wood acknowledged in a CNBC interview that she had vastly overestimated the severity of inflation. For escalating inflationary pressures beyond what she had anticipated, Wood cited supply chain disruptions and geopolitical factors like the war in Ukraine. A recession, partly fueled by poorly managed inventories, had already started, she added. About a month from now, the Bureau of Economic Analysis will present the first reading on the growth of the American economy in the second quarter of 2022. The Atlanta Fed's GDPNow forecast indicates that the U.S. economy will contract to zero during the second quarter, following a negative reading for the first quarter, according to MarketWatch, even though the Federal Reserve and the majority of the major U.S. investment banks do not expect a recession this year. Inflation has been a bigger issue, but I believe it has set us up for deflation. We were wrong on one thing, and that was inflation being as sustained as it has been, Wood said. According to Wood, supply chain problems had caused major retailers to improperly manage their inventories, resulting in a surplus of some finished goods, such as furniture, which were in high demand during the pandemic. Now does she have facts that uphold her views? Apparently, she does. She asserted that difficulties exist even in the best-managed companies in the world. In her 4 to 5 year career, she said she had never seen an increase in inventories as large as the one seen over the past year. Inflation is at multi-decade highs, and U.S. interest rates are rising, causing investors to realize that buying stocks with your imagination is a bad idea. Prior to recently, the investors with the most creative minds appear to make the most money before losing their gains in a matter of months. One of the best-performing stocks on the American market through 2021 is the ARK Innovation ETF, ARK, which serves as the poster child for the recent hysteria. As of the ETF peak on February 2021, shares have more than quadrupled from their pandemic lows. Even though some of the companies in its portfolio had business plans that appear to have come straight out of a science fiction book, they were still going to change the world. The fund manager for ARK Innovation, Cathie Wood, gained immediate public recognition. She was hailed as the next Warren Buffett by the media and Wall Street, as they typically do. The success of Wood's company's flagship, ARK Innovation, was compared to Buffett's Berkshire Hathaway BRKA, 0.01%, and held up as evidence that the young, forward-thinking Wood had surpassed the nonagenarian, has been Buffett. The more money came in, and the more sci-fi stocks ARK Innovation purchased, the better it performed. A lot of times, ARK became the biggest shareholder in smaller companies, which raised the value of their stocks and increased the net asset value of the ETF. As a result, investors experienced increased FOMO, attracted more wealth, and felt detached from the reality of the stocks ARK owned. At their peak on February 2021, ARK Innovation's assets had increased from $2 billion to almost $28 billion in less than a year. It's simple to criticize Cathie Wood. We must not. If not for her, another fund manager would have been responsible. Along with many other asset classes, the stock market experienced a brief period of insanity that was brought on by a confluence of low interest rates and massive amounts of liquidity injected into the market by Uncle Sam. Imagination was in abundance and common sense was in short supply in the market for a while. It's becoming clear how this movie will end. Increased interest rates are bringing stocks back down to earth. Investors who purchased ARK Innovation at the peak have lost about 75% of their investment. After mid-April 2020, anyone who purchased ARK and held onto it has lost money in the fund. The rise and fall of digital technology stocks, since the COVID-19 pandemic bears striking similarities to the Y2K bubble of 1999. Speculation surrounding dot-coms had already made the stock market frothy in the late 1990s. Corporations were worried in 1999 that instead of advancing us from 1999 to 2000, computer clocks would send us back to 1900s at the start of the 21st century. This led to a wave of upgrades to new software systems, even though it was only a risk for outdated mainframe computers. The demand for dot-coms that would ride the internet wave and revolutionize the world, along with Y2K fever, resulted in rising sales for computer makers and other technology companies, significantly increasing their earnings. Afterward, there were no issues as the clock reached a new century. Dot-com companies ran out of money from other people to fund their unprofitable growth, and tech companies discovered that pre-Y2K sales had advanced future demand. Investors anticipated that the record-breaking sales would continue, but they actually saw a drop in sales. Tech stock prices fell. Pets.com is just one example. There are actual businesses like Dell Computer, Cisco Systems Cisco, and Microsoft MSFT. Some companies, like Cisco, saw a brief decline in sales before starting to grow again. While Microsoft was fortunate to see sales marching higher as if nothing had changed, Dell and other companies experienced a year-long pause in growth. The prices of these companies took more than 10 years to return to their highs from 1999, which was a long wait for shareholders who owned shares. Earnings had to increase by that much before they reached 1999 valuations. Great companies can also become overvalued, so the price you pay for a stock matters. Similar to tech firms during the dot-com bubble and Y2K, digital tech firms saw a significant increase in sales during the COVID lockdown. However, the story that sales tell is a very brief and superficial one. These companies' cost structures have been significantly restructured. When a business expands rapidly, management is compelled to project the business growth in straight or even parabolic lines into the future. This includes hiring personnel and purchasing assets to support the company's future nirvana, while also preparing it for growth to continue. Companies must renormalize their asset and employee bases as the growth rate slows, stops, or even turns negative. As a result, there will be layoffs, and since these businesses frequently buy from one another, some will experience even more severe sales declines. Recessions are beneficial because they cause management to turn inward rather than outward. Long-term rapid growth is unhealthy. It generates numerous inefficiencies, increasing corporate cost structures. Many science fiction projects receive funding when the imagination is allowed to run wild. The bubble under these stocks might reappear. One can only hope. History indicates otherwise. Rarely do the same group of stocks experience a bubble twice. This has a psychological explanation. Investors who lost money on their initial investment tend to sell their stocks during run-ups. This would also necessitate the dissipation of inflation and the return of interest rates to new lows. In 2022 and possibly the following few years, the downturn will most likely get significantly worse. The stock price and valuation of digital companies that were adored yesterday and are still adored will decline. As they embrace new shiny objects, investors' affection for them may turn to hatred, then to indifference. Despite how difficult it may be to imagine now, some of these businesses will be abandoned. A lot of dot-coms and tech darlings in the early 2000s experienced this. While others will lose their relevance, some will develop into appealing opportunities. It then falls on me, as a money manager, to sift through the wreckage in search of faded market darlings with a chance of turning things around and purchasing their shares at a discount. The University of Michigan survey's measurement of the decline in consumer sentiment was another indicator, according to Wood, that a recession has already started. According to MarketWatch's report from last week, the closely watched indicator of consumer sentiment dropped to 50 in its final reading for June, down from a preliminary reading of 50.2 earlier in the month and significantly below May's level of 58.4. Since the late 1970s, the final reading has been the lowest ever recorded. Over the past week, more than $370 million has been invested in the ARK Innovation ETF, despite the fact that it has lost more than 50% of its value since the year began. For years, Wood has argued that deflation, not inflation, is the true economic boogeyman, insisting that deflationary trends like technological advancement and a slowdown in population growth will cause consumer prices to plunge. She remains steadfast in her position. Wood is confident that her ETF innovation-focused holdings will perform well in this deflationary environment and claims that her clients are sticking with her as a result. What do you think about all this? Tell us in the comment section. With this, we have come to an end. The content in this video is for educational purposes only and hence should not be considered financial advice. All the financial decisions should be made after doing your wide-spectrum research. If you find this info helpful, please give us a thumbs up and subscribe for more. It would mean much to us, and it also encourages us to produce more valuable content for y'all. Please share this video with your family and friends if you find it helpful to keep track of the market. If you do have a specific topic you'd like to learn, please leave us a comment below, and we'll work on it for you. Until then, stay tuned.